Indeed, good afternoon to our distinguished panelists and to all of you joining us online. My name is Vincent Keaveney. I'm the Lord Mayor of the City of London. And for those of you who don't know, that role means I'm an international ambassador for the UK's financial and professional services sectors, work where I'm supported by Alderman Alison Gowman, one of the sheriffs of the City of London, who's joining me on this visit to China. This seminar is an important part of that ambassadorial work, as it forms part of my virtual visit to China, taking place over the next few days. And today we're talking about a topic which matters to me a great deal. As part of my mayoral theme, people and purpose, I'm encouraging more purpose-led financial investment to help encourage a vibrant impact investment market. Of course, sustainable finance is a core component of this work. For example, we've only begun to think how COP26 provided a big boost to sustainable finance and how it helped shift capital towards sustainable activities and, importantly, shifted the conversation forward too. An important part of that conversation is the ESG data, which can help support firms in making better investment decisions. By the end of 2021, investors with over $130 trillion in combined assets had signed an agreement which integrated ESG information into their investment decisions. This has become an increasingly popular and powerful tool in helping market practitioners to assess ESG or sustainability risks and opportunities. Ultimately, investors need ESG data, tools, and analytics to aid decision-making. And corporations will need to develop a robust approach to climate scenario analysis. We've seen that investors are seeking financially material ESG data from companies, so building a data analytics capability could be important to both corporates and investors. The challenge now for the investment industry will be how to assess and analyze the data required to link social impacts to financial performance. And as a leading sustainable finance centre, the UK is well placed to support the investment management industry to address these challenges. Our financial and professional services sectors offer the critical mass of capital and expertise to develop the sustainable standards, measurements, and products. Innovation is key to all of this. For example, London is home to over 2,100 fintech companies, more than any other city. At their heart, these companies are responding because of changing demand. And I believe they're using our financial ecosystem to adapt to new opportunities at great speed and scale. The same will be true for organizations who are adapting to ESG demand. Refinitiv, for example, offers one of the most comprehensive ESG databases in the industry. It covers over 80% of the global market capitalization across more than 450 different ESG metrics, with a history going back to 2002. It's an impressive example of what can be found in the UK, and we're committed to increasing the quantity and quality of climate-related reporting across the UK business community. We want to ensure that businesses can consider the risks and the opportunities they face because of climate change, and we encourage them to set out their emission reduction plans and sustainability credentials. Indeed, we were the first G20 country to make it mandatory for our largest businesses to disclose their climate-related risks and opportunities, in line with the recommendations of the Task Force on Climate-Related Financial Disclosures, TCFD. And from the 6th of April this year, over 1,300 of the largest UK-registered companies and financial institutions will have to disclose climate-related financial information on a mandatory basis. Also, on the regulatory front, our government is considering bringing ESG data providers under the regulation of the Financial Conduct Authority in a bid to improve transparency and to eliminate data discrepancy. We've big ideas and we have great ambition. Likewise, we've seen China's ambition to hit carbon peak by 2030 and achieve carbon neutrality by 2060. The People's Bank of China has promised ambitious new climate disclosure requirements and have encouraged international collaboration as part of their efforts to drive a green transformation of Chinese banking. With these developments, there are significant opportunities for collaboration between the UK and China to meet the demand for ESG data. And I believe the experts we have here with us today will be able to share more on those opportunities and the challenges that we face. So I'd like now to hand over to Hilary Sue, who is the moderator today, to kickstart the panel discussion. Thank you all very much. I'm looking forward very much to hearing the panel. Thank you.
Thank you, Lord Mayor, for your very insightful introduction. My name is Hilary Sue. I work here for InvestTao based in London. We are a cross-border fund placement boutique working with the Chinese and the UK asset managers. This is our third year working with the City of London Corporation on the Lord Mayor Virtual Roadshow and the Global Investment Future webinar series. So on behalf of the whole team here, I'd like to extend our warm welcome to everyone who's joining us today. If you have questions for our panel today, please fill all of them into the Q&A box. At the very end of the discussion today, we'll be taking questions from the audience. So feel free to raise any questions for our panel today. Perhaps to help set the scene, I'd like to quickly highlight the sheer size of the ESG investment market in both the UK and China. Since 2003, sustainable UK assets have grown over 1,800% from £2.9 billion to £56 billion in early March last year. ESG funds in the UK have pulled in new client money at an average rate of £1 billion per month during 2020, the year of COVID. Currently, more than 40% of all fund industry sales in the UK are ESG fund units. China's ESG journey has been quite different than the key markets. The ESG investing has enabled China to align itself with global interests and put an emphasis on our performance. So today we're going to hear from our panelists to give all of our audience a view just on how ESG analytics has been enhancing investment returns from both the UK and China, and also how ESG analytics has been helping us reduce tail risk and protect risk control, manage risk in our investment. Joining me today in our panel discussion are four esteemed guests with a wealth of expertise. We have Lily Dai, who is a senior research lead in sustainable investments of FTSE Russell, Madam Helen Huang, CEO of Wrapup WP Fund Management, Dr. Vian Sharif, the head of sustainability from FNZ Group, and Dr. Wang Zhichuan, founder and CEO of Governance Solutions Group. Dr. Wang, you're the only male speaker today, so there's going to be extra spotlight on you, but no pressure. Without further ado, I think for the first part of the discussion, I want to talk about how technology has been driving ESG analytics and further towards driving the asset allocation towards ESG. Both China and the UK has been, like Lord Mayor mentioned earlier, pioneers in a lot of fintech technology and big data, AI, and etc. So I would like to hear from our panelists just on how you have seen that innovative technology solution has been helping us sort of shifting the investment towards a more sustainable and wider ESG allocation. I guess this is more of a question for Dr. Sharif. I know that FNZ Group is a fintech platform. You've worked with a very wide range of wealth managers or so asset managers. So perhaps you can kick off and as a start for us on this one.
Hilary, thank you to the Lord Mayor and Aldermen and our distinguished guests. Thank you so much for this privilege to participate in such an important and timely discussion. Yes, at FNZ, we run about $1.2 trillion worth of retail money, or we administer that via our technology platform. And so we've had the opportunity to understand the wealth of data sources that are out there in ESG, and we've seen the growth in demand for an understanding by retail investors and their wealth managers for the ESG impact of these investments. And how do we start? Exactly as you've said, we start by looking at where we can find great comparable data. I think what I would say about the role of technology here is that we have reached a really interesting point, and we've reached the nexus of three trends. First of all, we understand that there is awareness. We want to understand the impact of our investments on the world around us, both social impact and also environmental impact, because we see it every day. We are aware that there's an issue. There's a problem here. We need to understand how we act today to improve the future of our environment and the future of our society. The second important trend is that the regulator is starting to take note. So not only have we seen, as you said, Hilary, we've seen the adoption of things like TCFD reporting becoming mandatory, climate reporting becoming important, the EU Sustainable Finance Disclosure Review, and other very important governmental regulations coming in around the world on ESG. This is something that the regulator is taking note of and is mandating for disclosure. But the final piece of this puzzle, and what I think makes things different today from any other time in history, is technology. Technology has the power to source incredible amounts of data and process it in a format that means we can literally deliver it to our fingertips. We can understand the impact of our investments at a very granular level because we can process this data, we can match this data, we can calculate this data with incredible processing power. So that is why I think technology has the power to catalyze where we are today and deliver the ESG data that we need, both at scale, but also to people who've never seen it before. So the likes of us. We can understand now the impact of our investments on the world around us, and we can start to ask our asset managers, our asset owners, what direction of travel they're going to go in to support our own requirements. And the same, the institutional asset owners, the asset owners and the asset managers also have this data at their fingertips to be able to process and make incredibly complex decision making much simpler. Hilary, I think your microphone needs to be switched on.
Oh, sorry, I switched it off. Have you witnessed how technology has been helping the authentication process of ESG data? Because the data integrity and the process of qualitative research has always been an issue. So from a tech perspective and from a platform, I don't know, have you witnessed such transformation or development?
Yes, it's a great question, Hilary. The answer is that there's a lot that we can do because of automation. For example, we can start to look underneath top line ESG scores. So instead of saying, okay, Tesla rates are 78, we can actually start to look underneath that score to the underlying data. And obviously technology helps us do this at scale. It can also help highlight anomalies. So if we're looking at scores across industries or data across industries and we spot outliers, technology helps us pinpoint those and also helps us understand, okay, well, what's driving that? Is that right? Is it not? Should I ask a question of the company? What does this mean? So that technology helps all of those things. The underlying data is the underlying data. Technology helps us gather that more efficiently. So that's definitely a good thing. It means we can trawl annual reports. We can understand all sorts of reporting elements that companies are putting out there. I guess where there's still a gap, though, is in third-party verification of those reported numbers. That's still something we've got to do. But also, this is still unbelievably the early days of ESG data. Yeah. We still need human minds to filter through those anomalies, to ask those questions. Why is this water output really high in comparison to the industry? What's this company doing? So there are still lots of complexities in cleaning the data and verifying the data that require our thought process around it. And maybe in time we can automate them. But yes, on the whole, technology is really, I've seen a really seismic change in how it can help us.
It's interesting that you mentioned third-party verification. I guess that this will be a good time to invite Dr. Wang to share some of his input from China side. Dr. Wang, of course, your group GSG has been helping a lot of Chinese corporates and asset managers to really streamline their ESG analytic process. So just from a tech perspective, I don't know if there's any on-the-ground points you could share with our audience.
Yeah, thank you, Hilary. Definitely, I think the investment professionals know the importance of data and technology very well. As a service provider, we share the same view. When I started Governance Solutions Group 5 years ago, I asked one of my former clients, Bruno Reschel, the founder of the fund, Swiss fund Advic, to be my advisor, and he insisted to be an investor, and he told me I would need the funds, the money, to invest in technology, and that's exactly what we have been doing. Technology does make a huge difference, particularly on some quite formatted data in, for example, in the area of governance. It has been required for the issuers, public companies, to issue governance-related data for quite a long time. So we use AI internally and also work with outside vendors to just using technology to collect data and verify, then process. That saves a lot of time and efforts, definitely. And in analyzing that, of course, modeling still technology helps. But at the same time, though, I think, as just mentioned by the other speaker, actually, particularly for China, because of the requirements for ESG disclosure, it's not standardized, not there, definitely, generally. So it's depends on the issuer. It's pretty much a voluntary basis. So the data sometimes it's hard to gather even using technology. Still, that's why still we need to use a lot of manpower at the same time. So that's kind of the reality. But the trend as we develop definitely is going to be more and more reliant on AI, technology, and big data for sure.
Excellent. It's good to know that. I think after we had a brief discussion on the how technology has been empowering ESG analytics, perhaps it's the right time to move to how does this ESG analytics or actually helping investors making investment decisions, and how that part of analytics has been embedded in portfolio construction. So I think next I would like to invite Lily and Madam Helen Huang from Wrapup to share some insights on, just exactly how ESG data and ESG-oriented insights have been helping investors in their portfolio construction. So for both of you, have you or your team used ESG data or other metrics in your investment decision process? I'm sure you have. And if you could give us some real-world example from your fund, your product, just to highlight this process to help us understand how these type of analytics are implemented in the UK and China, that would be great. So now I'll hand over to Lily and Madam Huang. I mean, whoever wants to go first. So Madam Huang, would you like to start first with the overview on China and Wrapup?
Sorry. Okay. Thank you, Harry. Yeah, for the invitation and for this good question. What I would like to see is I really share the same view what Dr. Wang and Vivian just mentioned about. Currently, it's really data-driven or technology-driven, especially when we look at the ESG investing framework. It's from the research analyst to the portfolio construction, to the risk management, to the performance assessment, all this related to the data in-depth analysis. And because the data about ESG sometimes it's not like what we see from the financial reporting or accounting. It's not just standardized. sometimes fragmented, sometimes full of noisy. So that's why we need the tools to do the precise, to do the to make the data organized and to make it meaningful. You know, when we do the investment, it's like it's not naturally data can translate it into alpha. So it's pretty important. And especially I would share two views. I guess everybody agree that during the pandemic, these 2 years, and also we may face some post-COVID era. So there's lots of change, and lots of change at those two major trends is that it's the increasing growth of the fintech, and another is the increased awareness of ESG, especially in China. So, you know, I can show you one example in China. There's an online platform, we all know the Ant Finance and Tencent and also Oriental Finance. It has Tiantian fund networking. So, and so far by next year, end of next year, the equity and fixed income AUM has reached 1.29 trillion. That's already 400 billion ahead of the biggest bank of China, CIBC. And also it surpassed the merchant bank. Merchants Bank is the biggest wealth management banking. And that's not included is a very famous the money market fund, Wrapup, everybody knows. So we see that during the COVID, this benefit, the several sector benefit quite a lot. You notice the digital payment, yeah, and the online selling and the financial sector also benefits. And we can see the market change, market structure change, and the way we acquire the client change. And there's lots of merge acquisition. And also we see some kind of, you know, growing networking and partnership with influence, right, with brands, and also those like leverage trust to cross-sell the products. So all these sectors benefit. So let's prove why Ants and Tencent, the online selling is so, you know, popular so far in China. And in terms of ESG and China, you know, everybody is scrutinized right now. And the COVID really drive ESG awareness and ESG integration in the practice from the asset manager point of view. And, you know, EY recently released a survey and it's do some questionnaire for the 300 buy-side top executive. The report shows that 90% of the response see that they attach great importance to the company's ESG performance. And also near 3/4 shows that they may make some divest of those company with a very poor ESG scoring or ranking. So that's a very good sign that especially after, you know, 2020, the September, President Xi launched that carbon peak and carbon nutrition that's become national strategy. So from the asset manager point of view, right, we will need to use right data and quality data. And that's why we need to approach to those very powerful, those technology, that's tools to make those data actionable, also meaningful. So that's what we got to link with the fintech technology. So maybe I stop back here, then I answer your other question. I'll pass that to Lily. Mm-hmm.
Hi, Lily.
Hi, thank you for having me here. I think I fully agree with you know, what previous speakers have said. Technology definitely helps gathering the data, analyzing the data. For example, we can use now the NLP screening solution to kind of screen what companies we want, what kind of information we want, and to decide the materiality of that. But I also want to stress the point that the fundamental to the data is actually the disclosure and company reports. The technology can help process the data, but the original comes from companies. So I think the transparency from company, the quality of disclosure from companies are very important in this space. And in terms of the kind of the role of analytics in the portfolio constructions, I think it makes the kind of processing, analyzing data easier, because right now you can see we have many data points flowing in the world. We have traditionally ESG data, and now we have broadly kind of sustainable investment data, and we have the TCFD disclosure. So we have more data around carbon emissions, carbon targets, and then we have like investor-led initiatives like Transition Pathway Initiative or Climate Action 100+ to develop benchmarks, combining different data sets. So for example, we have the right now traditional ESG data, we have carbon emissions data, scope 1 to 3. I think the technology definitely helps with the modeling of scope 3. We have like green revenues data, which is the data analyzing companies with green activities to say what are the green revenues that are compatible with different taxonomies like EU taxonomy or China taxonomy. And we have right now, we can use technology or analytics to have different combinations of this data to deliver what investors want, depending on their investment strategy. For example, we have the FTSE Russell TPI Climate Index, which use all the data I've mentioned earlier, for example, the green revenues data. So if a company has more green revenues, we can overweight them in the portfolio. And we have carbon emissions data. So if a company has higher emissions compared to the peer companies, you may want to underweight them. We also have fossil fuel reserves. So if a company is deeply involved in fossil fuel, then we may assume it will have higher kind of climate risks. And of course, we have the carbon performance data to look at whether the company is on track to achieve 1.5 degree or not. And then we have management quality to look at the governance side of the company to see whether they have the climate strategy, robust climate targets. I think analytics in a way would help us to utilize different data set we have and to construct a portfolio in a way that can meet investors' targets. Sometimes, it's 1.5. And for some investors, it might just say like, I want ESG integration, I want minimum fossil fuel exclusion. So I think it really depending on the investors' strategy you can have and the ambition, you can have very different portfolio construction. But definitely, I think analytics can help us to combine different data sets to deliver a customized portfolio.
Yeah, thank you, Lily. I think we have evidence from both empirical and academic side suggesting that ESG does really help investors getting long-term investment return. So from you and Madam Huang's perspective, just by scanning through your funds and products, can you share some example on, let's say, 5 or 10 years? No, maybe not 10, but 5 years horizon. What kind of returns have you seen from ESG funds as opposed to others?
Yeah, so I have a slide showing the outperformance of one of our index. If we can bring up that chart. So this is I think 10-year scale. And here we're looking at FTSE Environmental Opportunities All-Share Index, which is a selection index, so only select companies with more than 20% green revenues, for example, renewable energy or pollution or water. And then this is the green line in this chart. We also have the FTSE Global OCAP, which is the market's benchmark. And of course, we have the Global OCAP oil gas industry just for kind of illustration purpose. So you can see over the last 10 years, the Environmental Opportunities Index has been outperforming the global benchmark and certainly the oil gas companies. So I think from long-term perspective, given that there's more awareness on the green economy, there's a need to grow the climate solutions, and there's a more kind of disclosure from companies. You can see in long term, the green kind of index have been outperforming the markets. And of course, if you look at the kind of the short term, you may see early this year the oil gas has been outperforming, but it's not really it's depending on the broader kind of market development. But you can see in longer term it has been outperforming. I'm just looking at, I think from 5 years scale, the environmental opportunities index has been outperforming by about 6% compared to the global benchmark, and compared to the oil gas industry, I think it's about 20% over the last 5 years. So even if you look at the time scale, in particular after Paris Agreement in 2015, the green economy has been growing rapidly, and even during the last year and 2020, 2021, the difficult time, it has been outperforming. But I also want to mention that, of course, it depending on the sector we're looking at. So in the kind of environmental opportunities index, we have different sectors like renewable energy. In fact, it's quite flat. The most, I think, growing market is actually the energy management and efficiency market. And then you can also look at like water or pollution, waste management, different sectors, they have different kind of performance within the index. But overall, I think in long term, the trend is that it has been outperforming.
I think. Thank you, Lily. I think I'll come back to you now, Madam Huang. From your experience of working and managing Wrapup, I don't know if you echo with Lily's and Fuzi's fund performance there. Maybe you can, I don't know if there's any example from your product solution line that from China you could share with us to highlight, whether you see similar performance or I understand that ESG investing is still in China, is still at the nascent stage, but perhaps you have witnessed a similar growth or even better, especially during and after COVID time.
Sure. Actually, what you asked, we already engaged with Fuzi. We have his green revenue data to build our framework. And to build a framework, you need to have quite lots of time to have those system and scoring system, and those system you need to have those parameters, those metrics. So it's really not just a 1 year journey. But at the beginning, we started our ESG back 2016, and 2017 we do lots of research analysts and learning from the Fuzi, like MSCI, and we start design the product by that time. So the first stage is we use green revenue and the carbon emission. That's what data available. So we can use that as a scoring and then build our stock pools. Then we can have our stock picking based on some fundamental research, on-site investigation to look at other fundamental factors like the growth, their value, or their corporate governance. Then that helps us to build the 2 funds. And first fund was launched 2018, and the second is 2019. And these 2 funds actually perform very well. So even though it's just a single fund, but we are confident that because the green revenue, at least you can look closely at the stock we picked in the specific sector, their green scoring is high. And plus there's some other factors we may choose to pick it. And I can show you some data that it's a 3 years cumulative return for both. Since its launch, one is a 3 year, one is 4 years. So it's reached like 92% by the end of last year. But last year is in the short-term period, last year is a booming year for the renewable sector in China, everywhere. Even those conventional sector like electricity power plant, if they have a transition plan, they have a very clear their carbon nutrition pathway or blueprint, those kind of stock shares also can be rated very relatively high compared with the peer group. So this can become our stock pool candidates. So that's the starting point. That's very important because you build your foundation to how to pick those stocks. But with help, of course, with the FTSE, with MSCI. Yeah. I can show you another example. We have a corporate with MSCI 2019. We launched MSCI ESG. It's called, at that time, there's MSCI China Inclusive. And it's a constitution of the stock, the indices is, I remember, it's 475, but ESG is almost similar, the number of the shares, but it's different scoring. So we track that indices, and the MSCI show the reporting of each scoring and also the performance of the ESG. So we can have a periodically assessment of the financial performance with their mother indices and the ESG performance. They have 3 metrics, of course. ESG, they have integration matrix, they have a governance interest, they also have a social. So let's give us a very give institution investor a very clear view how it performs, why it's high. I can show one data, and for the ESG indices integrate matrix, and these indices is 3.6, and compare with non-ESG performance is only 3.0. So you can see significant improves in the ESG performance, and the return also relatively high in terms of return, volatility, Sharpe ratio. So it achieves both financial performance plus ESG performance. And that's a very good example, and to demonstrate, yes, you can generate short-term performance, and the long-term pretty sure they will generate. So that's so bad.
Yeah, quite impressive. We've discussed, both UK and China and how ESG can help with funds investment return. I think naturally, the next question I will raise to the panel is how do you think ESG analytics can help investors to manage their downside risk? We know that especially in China, the market has been very volatile in recent weeks. And of course, like Madam Wang, you mentioned earlier, last year, sustainable asset in China has seen a record flow. I think China launched over 60 ESG or ESG themed funds. And under COVID in the UK, there's a record flow of new capital going into ESG funds as well. So it seems like, investors in both UK and China both acknowledge that ESG funds could be a safe haven to safeguard their money. So how does ESG really help investor, protect, control their risk when it comes to their investment, especially during the high volatility period?
From my point of view, it still depends on the analytical and the research investment decision framework. The starting point is the right data and the quality data. That's what's our topic about the data driving. And also we need to look at those alternative data, because ESG is a kind of alternative, right? And you got to use tools to do the process. And if you follow the media information, it's quite useful, because if on the daily basis you check if it's any negative news about the company, about the governance, about their pollution, whether there's excessive pollution discharge or any counterfeit the products, and it's meaningful. And we need a tool to follow it. And if we show only negative, we do in-depth analysis. If it's proof it's true, and you can divest it, you can exclude it from your stock pool, you stop investing it. In that way, you really can avoid risk. And we have some case like some pharmaceutical or some high pollution company, and even those companies with very poor governance. So I think Dr. Wang is very good at that. So let's really give great support when you do the portfolio, do the investment for the investor. Okay.
I think, yeah,
ahead,
if I can jump in, I think Madame Huang has covered the practicality quite well. I think for me, it's more like the conceptual level. If you think about like the long-term climate risks, if you are divest from fossil fuel business, if you kind of implement exclusion, in theory, you are mitigating long-term climate risks. And of course, if you look at our transition to low carbon green economy, if you actually invest in more climate opportunities like water pollution control or waste management or renewable energy, you are actually capturing the long-term opportunities we are having when you are transiting to the low carbon economy. Well, for us, it's, the conceptually it works, and I think the long-term performance shows that it works. But of course, I will leave to the practitioners, to investors, talk about how actually it impacts them.
Thank you, Lily. Next, actually, I would like to move on to talk about corporate and stakeholder engagement, because we need every part of the society to contribute. Otherwise, that kind of outperformance we get from ESG investing is unable to be sustained. And corporate and stakeholder engagements is a very big topic. I would like to hear from Dr. Wan and perhaps Dr. Sharif, just from your perspective, how have you witnessed Chinese or UK corporates as managers have been engaging themselves on this dialogue, and how this very wider conversation is being moving in the whole ecosystem? Dr. Wan, would you like to share some of your comments or experience from GSG working with Chinese corporates and asset managers onshore?
Sure. Yeah. As a part of the City of London ESG Leadership Forum, actually GSG has the pleasure and honor to participate in a study titled "Value Creation of Active Engagement." Together, I worked with Helen here and Professor Bob Eccles and other experts. We interviewed a dozen asset managers from both the UK and China. And the conclusion we had was that even though the particular approach of engagement may differ, but the asset managers from both markets realized that the importance of active engagement at the system level, market level, and organization level. So talking about the system level, since the launch of the report, we have seen both AMAC, the Asset Management Association of China, and IAMAC, the Insurance Asset Management Association, have formed a ESG committee. For the AMAC ESG and Sustainable Investment Committee, Helen here is the chair, and I'm very honored to be the only service provider representative on the committee. We are undertaking several studies, research projects, and stewardship code is also one of the topics to be considered by both AMAC and IAMAC. And at the market and entity level, we're also assisting our clients, particularly asset management clients, to develop their active ownership, stewardship policy and practice. Some of the Chinese managers are also teaming up with the UK peers in the efforts of engaging with big SOE investee companies on sustainability issues. So what we have been doing is to assist the client and also try to work to form a collective efforts, in a collaborative fashion to let's say promote sustainability and the engagement with the companies, and this is particularly helpful on some corporate governance issues because the governance side is not only on sustainability. Sometimes it's just directly linking to big time like scandal and the risks. So that's something we at Governance Solutions Group are trying to address. as the last note on engagement, I think a potential angle for engagement to become more useful is to serve as a supplemental approach to obtain sustainability data to meet the EU SFDR requirements. Because if the asset level, let's say the issuers, the bond issuers, or the listed company, they're not disclosing climate-related data, neither other ESG data, which is investing useful. Then to meet the SFDR requirements, you can engage with the company, try to encourage them to disclose or get the information still publicly available, but it's not formally disclosed. That's another way to, I think, to interact, engage with the company, and serve the sustainability investment purpose.
Yeah. Thank you, Dr. Wang. Dr. Sharif, do you have anything you would like to raise or comment concerning corporate engagement before we move on to QA? We have quite a few questions lined up already, so I would like to give our audience some time as well.
Sure. So look, Hilary, I'll just do a 2-minute wrap up then, because Dr. Wang has already made some excellent points. It's interesting. If I asked you how many times you interact with your mobile phone every day to look at your bank account, all of us, how many times do we do that?
I really want to know how many hours I get on my phone.
What's interesting is that wealth and investment solutions are now being delivered via this interface. And what's also interesting is that because we've developed solutions at scale to show you the sustainability aspects of your investments, we are engaging with a new audience of retail customers who care deeply about, obviously, the returns from their portfolio, because this is about supporting a dignified retirement and all the other goals we have in life. But many of us are also saying, well, look, I also want to make sure that my values are covered here, and I want to make sure that my risk return profile is covered appropriately. And from the studies that we've seen, there is no reason to sacrifice return for sustainability performance if optimized correctly. And I think we've had some fantastic input here from the panel on that. So I believe what we're going to start to see is a shift in consumer awareness that their investments have an impact on the world around them, a move to sustainable investment strategies, as we've been evidenced by the growth in those sustainable investment strategies, because we're able to actually start to see these returns and this impact and our investments much more easily as customers and consumers. And from that, we will engage with our asset managers to develop products that suit us, and direct indexing products. And this takes a different lens, it's a different lens on how the market may evolve. Instead of having asset owners who influence asset managers to create product to sell to us, which will still go on, we'll have another driver, which is us looking at our investments and our impact, influencing our asset managers and saying, we would like these kinds of products, and that will support the proliferation of sustainable investments, I believe.
Thank you, Dr. Sharif. I think now I'll draw some questions from our audience, and I'll take the questions which I think both of our panelists can share some view from both UK and China. There is one asking about tech companies in ESG funds. So for example, a lot of ESG funds have technology companies like Alphabet or Tencent, and a lot of these names would outperform, but not exactly for the ESG reasons. A bit like, oil and gas funds are doing really well right now, but not for the right reasons. So where can one get data which identifies those quote unquote dirty emitters who make a real change and can really turn the dial and deserve the rewards from investors? I don't know who would like to share some of the insights from that.
Can I clarify the question? The question is, who are the largest emitters and how can we identify them and to look at whether they are.
It's not about the emitters. So basically, there are a lot of tech companies who do well. They have companies like Alphabet, Tencent, but the reason for them to outperform is not for ESG reasons. I mean, I don't know if our panelists, if you know Alphabet or Tencent well, you can probably create a case and saying Tencent and Alphabet perform well because they have supreme governance standards. That's why you think they actually do well because of ESG reasons. But the person who raised this question, seems to believe that these companies perform well not because of the ESG reasons. So where can one get data which identifies these dirty emitters? So they're identified reasons to not cause them to do well, and who can make real changes and can turn the real dial and deserve the rewards from investors. Does that clarify?
I think so, but I guess it's a very difficult question because it's very difficult to separate separate the markets, right? There are companies going very well because, for example, the technology sector is going very well. There, even because of COVID, we invest a lot in technology, in video conferencing, in cloud computing solutions. So there might be a reason why that's growing well. But there are some technology companies doing, for example, green business. Like what I mentioned, cloud computing is actually captured by our green revenues data because we think that reduce energy use, and to some extent video conferencing as well, because you can reduce your carbon footprint by transport. So some companies, we do capture them, but they are performing very well, not just because they have some green activities, but also because I think the broader market's impact.
Yeah, I think the question, oh, sorry, Dr. Wang, go ahead.
Yeah, can I just make one point here on the technology sector? Not necessarily commenting on those particular two companies. A while ago, I spoke to a group of investors concerning about the regulatory risks in China concerning the platform businesses. And we tried to identify potential ESG exposure that cause these companies, cause the investor damages. So that's one area we identified. It's the regulatory governance related or social responsibilities. If yes, technology sector get a lot of resources and enjoy the high growth. At the same time, if in a society like China, if you don't consider the social aspect, the treatment of your employee, and the broader other stakeholders, and the risk is for sure it's just a matter of time, sooner or later. So it's not like we're not commenting on the government policy, just from the investor and the company perspective, how to avoid the risks from the ESG side. It's a great tool actually to screen and predict risks. So that's a kind of conclusion we draw.
Thank you, Dr. Wang. I think this question actually just highlights what we've discussed earlier, that there is no cookie cutting type of one size fits all ESG data analytics. Sometimes, or very often, we have to rely on human intelligence to help us make better informed decisions. On that note, I shall pause here and hand over to Lord Mayor to reflect on the discussion and close the discussion today. Thank you.
Thank you very much, Hilary, and thank you to all the panelists. It was a really insightful, very high quality discussion today. I just hand over to Sheriff and Alderman Alison Gowman, perhaps for some thoughts at this point before we wrap up.
Yeah, I agree with you, Lord Mayor. It has been incredibly interesting to see, and so much complementary strength from the UK side and from the China side. And it's clear that the working together and the future working together, I'm sure, will actually build on all of that. We've seen how clearly analytics are so key to what people are looking at, both from the investor, but also we've also heard latterly about the corporates, how they're viewing this issue. And Dr. Sharif talked also about, the retail interest on these things. The consumer are so concerned about how ESG works. And that also goes both to the downside, the times when things are not so easy and the risks are turning away, that actually ESG has shown to be a critical point to the way that we can review how we work and think about these things. So clearly, data is key. Transparency and the quality of that data is so important. We did touch on whether or not third-party verification also needs to be increased, and that's clearly an area where I think our fintech companies are going to be working hard on that. That data needs to be so consistent. We need to have standardized data, and again, I think that's very important across the piece. We see how AI is really useful, but there's also areas where human involvement is still very critical, and that can slow things down, but it also can be important to make sure the analysis is correct. The active engagement of our investors on all of these areas will be so important to drive both sides to get better clarity, better understanding, better investment, and at the end, better outcomes at ESG. So thank you all for working on those ideas, and back to you, Lord Mayor.
Thank you, Alison. I think we all recognise the discussion today, recognise the challenges around this, but also the great opportunities. And the opportunities indeed for China and the UK to work together on this agenda to improve data, to improve transparency, to improve the investors' ability to make those informed decisions in this increasingly important space as has been referred to on a number of occasions over the course of the panel. So thank you again to Hilary for moderating, to Dr. Wang, Madam Wang, Dr. Sharif and Lily Dai as well for your contributions today. It's been a really good panel discussion. I'm sure that everyone watching online will join me in thank you, and I wish you all a very good rest of the day. Thank you all again for your joining us today. Bye-bye.